Okay, everyone, Assalamu alaikum, and welcome to the Prepare to Pass session of the paper SBR Strategic Business Reporting. I'm your trader Hamza Abdullah, and today is day 2 for the session. Yesterday, we had discussed the area of consolidation, in which we have discussed the basics of the consolidation. We have discussed the area of disposal, and we had discussed the area of step acquisition. But due to shortage of time, we were unable to attempt the questions of the step acquisition, which we are going to start from today. And today's target is going to be the area of foreign subsidiary, and then we are going to discuss the area of the cash flow statements. So first, we are going to start quickly with with some of the questions of step acquisition, and then we'll be moving towards foreign subsidiary and then the cash flow. So the session timing are from 8 p.m. to 11 p.m. and we're going to take a break exactly in the mid, which is going to be 9:30 p.m. So this is the plan for today's session. Let's start it. So let's quickly recall things a bit that we had discussed about the step acquisition, that in case we had an investment, let's say 10%, and we acquire some new shares, let's say 60%, and now our holding is 70%. So in this case, the accounting is based on an assumption that the old investment of 10% is sold and repurchased at the fair value. So we are going to bring the carrying amount of the old investment to its fair value. Now we are solving a past paper question which is by the name of Bravado, which was a past paper question of P2, where usually the carrying amount of the old investment was given in the balance sheet, but in the SBR paper, the question is going to be providing the value somewhere inside the scenario. Okay, so a quick view on your messages. Salman is saying that he has come very fast from university to join the session. Thank you, Salman. Abdullah, you can ask your question right over here where you are posting. And Sabah is saying that I couldn't get the notional goodwill concept yesterday. Okay, Sabah, the Chandler question that I had given, she's facing problem over there. Yes, Siobhan, your messages are visible to me. And Tasbiha is saying sorry for joining 3 minutes late. What do you start with? Tasbiha, we have started with just a quick recap, and now we are starting the question actually. So this is a Bravado question. Let's read it out. The question says that on 1st June 2007, Bravado acquired 6% of the ordinary shares of Mixed. Bravado had treated this investment as fair value through OCI. Available for sale is a word which used to be there, but now we know it by the name of fair value through OCI. So in the financial statements to 31st May 2008, but had restated means changed the investment at cost on Mixed becoming a subsidiary. This means that the question is trying to say that we are exactly carrying the investment at the cost. On 1st June 2008, which is 1 year later, Bravado acquired a further 64% of the ordinary shares of Mixed and gained control of the company. So we actually had 6% shares. Now we have acquired further 64 and we are holding now 70%. So what we need three values. We need the cost of the old investment, we need the carrying amount of the old investment, we need the fair value of the old investment, and we need the cost of the new investment. So cost of the new investment is 118 million, cost of the old investment was 10 million, and according to the question, the carrying amount is the same as the cost. So this is also exactly 10 million. So now we just need to have the fair value of the old investment to start writing down the answer. Okay, so now the question further says that on 1st June 2008, which is the date when we have gained the control, the fair value of the equity interest in Mixed held by Bravado before the business combination was 15 million. This is the fair value given by the question, that the fair value of the old investment was actually 15 million. And the fair value of the non-controlling interest in Mixed was 53 million. So this means that when we are calculating the goodwill in the working, we are going to write the cost of the investment as the fair value of old investment, which is 15 million, plus the cost of the new investment, which is 118 million. So this is going to be a total of 133 million dollars of the cost. And then we are going to add the fair value of NCI by 53 million. So this will give us a value of 186. And when we get the net assets, we can simply deduct it from 186 to get the final value of the goodwill. And if we talk about the accounting entries, we remember that the accounting entry should be the old investment credit. I'm writing it over here. And the goodwill debit. Goodwill we are going to debit by the fair value of 15, which we have used in the cost of the investment while calculating the goodwill. And we are going to credit the value of the investment by the carrying amount, which in this case is going to be $10 million. And this will result in a gain of $5 million, which should be recorded into P&L. Okay, Nimra is feeling that I'm going a bit fast. Okay, Nimra, I will get a bit slow. Kabir is saying, Assalamu alaikum, sir. Can I get the handout link for June 19? Kabir, the June 19 past paper has been attached in the handout section of the screen that you can see. You can download it from over there. Merrick is saying that is the 15 million added because you would have de-recognized the investment and recognize it again since it is moving from an investment to subsidiary. Yes, exactly, Merrick, you are right. So according to the assumption, we used to sell the old investment. So because we have sold the old investment, we have credited it. And according to the assumption, we have reacquired it at the fair value. That is why we have debited the goodwill, and the balancing figure is then taken to the P&L. Sabah Zahid is saying, why not OCI? Okay, yes, that is a good question. Sabah is trying to say that when the category was fair value through OCI, then why we are taking this to the P&L? So the answer is pretty simple, that when we discuss, when we're going to study IFRS 9 in tomorrow's session, we are going to understand that the category fair value through P&L and the fair value through OCI, in both the cases, the gain or loss on disposal is always taken to the P&L. The gain or loss on disposal is always taken to the P&L. So according to the assumption, we have disposed it off. That is why it is a realized gain and we are taking it to the P&L. Yes, exactly, Ripon. Okay, so any confusions in this question? Raja Vakar is saying that profit will be recorded in P&L as well as in the retained earnings working. Yes, exactly, Raja. When we're talking about the income statement, this means P&L, and when we are talking about the balance sheet, we mean the retained earnings. Merrick is asking at which point does it goes straight to retained earning? Merrick, in case of subsidiary to subsidiary, where we had approximately, let's say 60% shares, now we have 80% shares. So we already had the control and it is being increased. In that case, we take the gain or loss directly to retained earnings without taking it to P&L. Okay, now we have another question by the name of Robbie. In this question, I'm going to tell you the carrying amount because it is not mentioned in the question. And we're going to assume that the carrying amount is $3 million of the old investment. Mohammad Naseem is asking, can you summarize the question once more? Mohammad Naseem, the question that we are previous one. So the summary will be covered over here. Tamina is saying you make SBR seem so easy. Thank you, Tamina. So now let's solve the question of Robbie. It says that on 1st June 2009, Robbie acquired 5% of the ordinary shares of Zinc. This means again it is an investment. Robbie had treated the investment at fair value through profit and loss, fair value through P&L in the financial statements to 31st May 2011. On 1st December 2011, which means approximately 1.5 years later, or maybe 2.5 years later, Robbie acquired a further 55% of the ordinary shares of Zinc and gained control of the company. So we were having 5% of the shares and now we have acquired further 55%. So it is a subsidiary with the holding percentage of 60%. Mohammad Ajmal is saying that which paper are you looking these questions? Ajmal, these questions are there in the PowerPoint presentation attached in the handout. These questions are there in the PowerPoint presentation attached in the handout section of the session. Okay, thank you, Salman. Salman is saying that, sir, you are a legend. Thank you. Shehzad Javed is saying on disposal, equity investment held at fair value through OCI not recycled to profit and loss. Yes, Shehzad, you are right. Okay, getting back to the question further says that the 5%, the cost of 5% shares was 2 million. The cost of 55% shares is 16 million. So in case of piecemeal acquisition, we always need three things: the original cost of the old investment, which was 2 million, the carrying amount of the old investment, which is 3 million, which I have mentioned over here, and we still need the fair value of the old investment, and the cost of new investment is actually $16 million. Now the question says that on 1st December 2011, this is the date when we have got the control. The fair value of equity interest in Zinc held by Robbie before the business combination was 5 million. This means that the fair value of the old investment is 5 million. So can you tell me the entry? What entry should we be recognizing? Okay, so Tasbih is saying that goodwill debit by 5, investment credit by 3, and PNL credit by 2. Exactly, Tasbih, you are right. Jagmeet is also right. Ali Khan is also right. Salman, CA means carrying amount. CA denotes to the carrying amount. Okay, so yes, we are going to make the entry as the goodwill debit by $5 million, which is the fair value, and we are going to credit the investment by $3 million, and we're going to get a gain in the P&L by $2 million. Now, when we are going to calculate the goodwill in the balance sheet, the cost of the acquisition is going to be the 5 million for the old investment. It will be 5 million for the old investment plus 16 million the cost of the new investment. So we are going to use 21 million as the cost while calculating goodwill. Sardar is asking, where did you get 3 million from? Sardar, 3 million is the value that I had given in the question, because this is an old question of P2 where the carrying amount was given in the balance sheet, which I haven't written over here because of the shortage of space. So this is the carrying amount which was given in the question in the past paper, which I've told you people over here. Okay, so now the question further says that it is Robbie's policy to measure the non-controlling interest at fair value, which was $9 million. So we should be adding the fair value of NCI by $9 million while we are calculating the goodwill. So this is how we have performed the calculations. But in SBR, one thing which is going to be very much important is the theory part of the answer, because only the calculation will not be sufficient for us to pass. So in the third question that we are going to solve in the next slide, I'm going to write a complete theoretical answer of how you are expected to communicate to the examiner in the exam scenario. So this is the question of mini which we are going to solve now, and I'm going to write a complete answer for this. Let's go through. Ali Khan is saying, what about the net assets? Ali, actually, the question haven't given the net assets right now, because the part of the net assets is the same in disposal, in step acquisition and everything. So when we are focusing on the step acquisition, the most important thing was the cost that we have understood. When we read the remaining question, it will tell the net assets, and we can simply deduct for the goodwill. Okay, so now we are solving the question of Mini, which says Mini acquired 14% interest in Putin, a public limited company, on 1st December 2010 for a cash consideration of $18 million. So we can say that the cost of 14% shares is $18 million. The investment in Putin, the investment was accounted for under IFRS 9 and was designated at fair value through other comprehensive income. So this means that we need to reclassify the gain previously recorded in OCE to the retained earnings directly. On 1st June 2012, which is 1.5 years after the acquisition, Mini acquired an additional 16% interest in Putin for a cash consideration of $27 million. So we have acquired further 16% shares at a cost of $27 million and achieved significant influence. So this means that if we plot a timeline, this was 1st December 2010, and exactly in the mid of the current year, which is 1st June 2012, we have acquired further shares and gained the influence. So this means it was an investment in the first 6 months and it was an associate in the last 6 months. So we have increased our holding in the investment to make it an associate. Now the question further says that the value of the original 14% investment on 1st June 2012 was $21 million. So this means the question is talking about the fair value being $21 million. And again, like the last question, the carrying amount was given in the balance sheet, which I'm going to tell you for this question, we are assuming $20 million. And I am actually highlighting this so that we remember that this is a value which we have assumed. It was given in the balance sheet um, of the actual question, but I have given you in the question separately. Okay, let me complete this. After that, I'm going to take the questions because some people are posting the questions. If I focus on the questions, the question will be left. So let's complete it because this is a difficult one and we also need to write its theoretical answer. So now the question is saying that the carrying amount was 20, the fair value is 21, the cost was 18. So if we prepare the accounting entries, we are going to say that the investment in associate debit, instead of goodwill, we are this time writing investment in associate because this is a case from investment to associate. And we are going to credit the simple investment, the financial asset, by the carrying amount of $20 million, and remaining $1 million is the gain on disposal, which should be recorded in the P&L. So this is the entry that we should be recording. Plus, one more thing which is very important. is the difference between the cost and the carrying amount, which is of 2 million, which would have been recognized in the OCI. So we need to transfer that from the OCI to the retained earnings, and anything which is taken to the OCI means for the year basically, and in the balance sheet it goes to the other components of equity. So from income statement perspective we say OCI, from balance sheet perspective we say OCE. So because this is a gain which might relate to a lot of previous years, that is why we are saying this OCE, which should be OCE debit by 2 million and the retained earnings credit by 2 million. Yes, Sean, we haven't read the question completely yet. We will continue the question. So right now we have solved the impact that relates to the step acquisition case. Now the question further says that Putin made a profit after tax of 20 million and 30 million for the years to 30th November 2011 and 30th November 2012. This means the profit for this year was 20 million when the company was a simple investment to us. Similarly, the profit for this entire year is 30 million. So we are going to record our share of profit only when it was an associate. So this means we only need to record the profit for this 6 months. So if the entire year's profit was 30 million, the profit for the last 6 months should be 15 million, and our holding percentage is 30%. So we are going to record it by 4.5 million, and the entry for the share of profit should be investment in associate debit by 4.5 million and the P&L credit by 4.5 million. So this is how we are going to record our share of profit. Okay, now let me check with the questions. Pooja is saying, sir, how would we know which OCI item may be reclassified to P&L? Pooja, there is a list of OCI items which are reclassified to P&L and a list which is not transferred. Do remind me. I will tell you people the list in on the day 5, so that once we have studied all of the standards, it will be easier for us to understand that list. That is why I'm keeping it for day 5. Do remind me in that on that day. Merrick is saying, unsure of how you got 2 million, the OC and the retained earning. Merrick, the 2 million is basically the difference between the cost of 18 million and the carrying amount of 20 million. This is how I've got the difference of 2 million. 18 million minus 2 million is the difference which we have got. Menza is asking that how we treat the dividend. Menza, we haven't discussed the dividend yet. So let me complete the question. The question further says that on 30th November 2012, which is the last day of the year, Mini received a dividend from Putin of $2 million, which means we have received a dividend from associate. Now, when we receive a dividend from associate, what is the correct entry for that? The correct entry is the bank debit by 2 million and the investment in associate credit by 2 million. This is the correct entry that we need to prepare when we are talking about the dividend received from the associate. But the question says which has been credited to other components of equity. We have credited it to the other components of equity, which is an incorrect entry. So we should be debiting other components of equity, and we should be crediting the investment in associate to correct this mistake of the question. So in total, 4 impacts were to be recorded in this adjustment. Sumaira is asking, sir, this 15 million, how it's taken? Sumaira, it is the entire year's profit, which was 30 million, we have actually divided it by 2 because this is the annual profit. So 6 months profit is going to be 15. Ali Khan is asking why profit on investment is not recorded. Basically, as per IFRS 9, the investment is dealt as per IFRS 9. IFRS 9 says that we should be recognizing the fair value movement as a gain in the P&L, not the share of profit. But in case of associate, we apply equity accounting as per IS 28, which says that we should be recording the share of profit in the P&L. Yes, Ali Kani, this will be dealt under IFRS 9. Abdul Qadir is saying, sir, could you please elaborate further for the reason why we need to transfer OC to retained earning? Abdul Qadir, we have discussed this in the uh, previous session in day one. You can check the recorded videos over there. Nimra is saying, why have you used 30%? Nimra, because we actually had 14% of the investment and later we acquired further. Sorry. So we actually had a holding of 16%, 14%, and in the later years we acquired further 16%. So now our total holding is actually 30%. That is why we have taken 30%. Raja is saying, sir, what about 27 million? Raja, basically now the investment in the balance sheet, the value that will be taken in the balance sheet is going to be 27 million of the new investment plus 21 million of the old investment plus 4.5 of the share of profit minus 2 million of the dividend. So all this will make a total of 52.5 million. So this is how we are going to use 27. So now we are going to write a theoretical answer of this question as well. Let me open a Word document for that. Okay, so now we are going to write down the answer and we are going to say that this is a question of mini that we are writing. And we are going to say that in case of step acquisition, the accounting is based on an assumption that the old investment is sold and repurchased at fair value. This results in the cost of the investment to be the cost of new investment and the fair value of the old investment. In case of mini, the investment in Putin was increased from 14% to 30%. Therefore, it is a case of step acquisition where the fair value of the old investment was $21 million and the cost of the new investment is $27 million. Therefore, the associate shall initially be recognized at $48 million. The gain on disposal of the old investment should be $1 million, which is the difference between 21 million and the 20 million cost, which should be recorded in profit and loss account. As the old investment is sold, the previously recognized gain of $2 million in OCE or the OCI is realized and shall be reclassified directly to retained earnings. So this is the answer that we should be writing for the step acquisition case. As for the current attempt, step acquisition is very important. That is why I'm writing the answers so that you people are aware of how to express your calculations into wordings. Shehzad Javed is saying, sir, how you determined the carrying amount of 20 million? Shehzad, it was given in the question. Actually, it was not directly given in the question, but the original question, which is of P2, the carrying amount was given in the balance sheet. So because the screen was small, I was not able to insert the balance sheet as well. That is why I gave you the carrying amount directly. Milos is asking, can I have the Word document? Yes, Milos, I will share the Word document on the WhatsApp group. I even shared the documents of the yesterday's session on the group, and still I have to add not some, a lot of people, because I have been continuously receiving the additional the request to get added in the WhatsApp group, but approximately 220 still message requests I have. So it is a bit time consuming for me to individually reply to all of you, but I will try that to add all of you in by today, most probably. Thank you. Okay, so now we are going to write the answer for the accounting for associate as well, because we are recording the share of profit and the dividend as well. So we're going to say that accounting for associate is dealt as per IAS 28. The accounting for associate, or we can even say associates, are accounted for using equity accounting as per IAS 28, where the share of profit is recorded as a part of profit and loss, and it increases the investment in associate. Further, any dividend received from associate reduces the value of the investment in the balance sheet. In case of Mini, the share of profit in the last 6 months was $4.5 million and the dividend was $2 million, which will result in the investment in associate being valued at $52.5 million. Is it 52.5 or is it 15? It's 27 plus 28 is 48, 52.5 and 2. It's I think 50.5. So it's going to be 50.5. Let me use a calculator as well. 21 plus 27 plus 4.5 minus 2. Yes, it's 50.5. Okay, Ripan is saying, what do we mean by equity accounting? Ripan, actually the accounting for associate defined in IAS 28 is called the equity accounting. A single name given is actually called equity accounting. Krantivir is saying, can we write the short forms in exam like PNL, SFP? Yes, Krantivir, you can write it because the objective is to convey the understanding to the examiner, not the full words. But we should try to use short forms only when we are short of time, and only when the word is self-explanatory. Sabai is saying, sir, I'm confused what comes to OCI and what comes to OCE. Sabai, everything which goes to OCI can be said OCE in the balance sheet. So everything that goes to OCI goes to OCE finally in the balance sheet. Manu is saying we will score 1 mark for one valid point, or with throughout description how much to write for 1 mark. Manu, yes, you are going to get 1 mark for every one relevant point. But when we are writing a descriptive answer, we normally cover multiple points in that. Usually every 3 line paragraph will approximately cover 2 marks. Every 3 line paragraphs will cover 2 marks. So approximately 2 to 4 to 6 to 8 and to 10. So this is an answer of approximately 8 to 10 marks that we have written. Okay, somebody had Ebesta wanted to have the snapshot. Ebesta, you can get it now. Yes, Sabha, we are going to try to take out time for the notional goodwill, but we are going to discuss the foreign subsidy as well and the cash flow, because those are also some important parts of the exam. So let's continue. We are done with the step acquisition. Now let's move on towards the foreign subsidiary case. Let me save this file first so that I can share with you people later on. So this is day 2 and by the name of Mini. So yes, we have saved this down. Now, when we talk about the foreign subsidiary is one of the questions that was asked in March 2019, and the hybrid paper published by ACCA was a combined one for March and June, in which that question was actually published. So let me rotate the laptop first so that it's easier for me to write on it. Okay. Okay, now we are discussing the foreign subsidiary case. This is one of the difficult cases of SBR. No, Shahzad Javed, we haven't discussed the joint arrangements. So we are starting the case of a foreign subsidiary. This is going to be a difficult one. So I want all of you to be with me on every second. So let's take an example that we are a parent and we have a subsidiary, and the parent has non-current assets of, let's say, $100 million, and the parent has an investment in associate of, let's say, $40 million, and the parent has some current assets of $10 million. So this is a balance sheet footing of $150 million, and the share capital, retained earnings, and liabilities are going to be there. So we'll need some more space. So the liabilities are, let's say, $5 million, and the share capital is $90 million, and retained earnings are $55 million. And the value of the share capital of the subsidiary is, let's suppose, 180, retained earnings are 40, and the liabilities are 10. So this is a total of 230 million. And the breakup of this is 30 as the current assets and 200 in the non-current assets. But the question says that the value of the parent is in $1 million and the value of the subsidiary is in million dinars. This means that it is a foreign subsidiary. Okay, Adi Chaudhary, I will share the tips and techniques for that. Now let's suppose the question says that the parent acquired 80% shares of subsidiary when its retained earnings were 30 million dinars and its fair value of NCI was, let's suppose, 60 million dinars. And for this, we also need the exchange rates. So the exchange rate at acquisition was, let's suppose, $5 per dinar. The rate at the balance sheet date was, let's suppose, $4 per dinar. And the average rate was, let's suppose, $4.5 per dinar. So this is the information that will be given to you in the exam. And now we are going to solve this question. I'm going to change the marker. Okay. So now when we talk about a foreign subsidiary, how do we start the calculation? I'm going to add a new page for the answer. So this is the question, and here we are going to write the answer. So when we're going to start the answer, we actually prepare a working which is by the name of net assets, in which we prepare two columns: net assets at acquisition, net assets at the balance sheet date, in which we have the share capital and the retained earnings. The share capital and the retained earnings of subsidiary was 180 and 140 million dinars. So we are going to write 180 and 40, which is going to be 220. The share capital was the same as 180 at the date of acquisition as well. And the retained earnings at the acquisition date was 30 million. Mohammad Saqib is asking 5 dinars per dollar or $5 per dinar. Mohammad Saqib, this is $5 per dinar. $5 per dinar. So the retained earnings were 30 at that date. So we are going to get net assets at the date of acquisition of 210. And now what we are going to do is we are going to apply the exchange rates onto this, because these are the values that we have calculated in dinars, but we need to convert them into dollars before actually consolidating them. So which rate should be applied on 210 and 220? Which rate should we be applying on these values? Can somebody tell me? Okay, everyone is saying closing rate. Raja is saying opening rate. Salman is saying average rate. Basically, the rate at acquisition should be applied to 210, and the rate at the balance sheet should be applied to 220. So if I go back, the rate at the date of acquisition was $5 per dinar and balance sheet was $4 per dinar. So we are going to apply 5 onto the date of acquisition, and we are going to apply 4 onto the balance sheet date. So this is divided by 5 and this is divided by 4. So the rate should be the same as the net assets. Net assets at acquisition, the rate at acquisition. Net assets at balance sheet, the rate at balance sheet. Okay, so divided by 5 and divided by 4. What is the answer that we are getting? Can somebody tell? It is going to be 42 and I think 55. Thank you, Abdul Kadir. Thank you, Rosie. Thank you, Sabah. So now we have got the net assets. If we try to check the increase in the profit, that is $13 million of the profits that we have seen during the current year. So now out of this 13 million, Kelly Canny is saying you didn't thank me. Sorry, Ali Canny, thank you for that. Okay, let me go back. And yes, let's change the rate actually. Otherwise, the question will be very difficult. And we're going to say that this is 5 dinars per dollar. And this is 4 dinars per dollar. And this is 4.5 dinars per dollar. Okay, so as let me tell you how to decide the multiplication, the division rule. We are actually having 210 dinars. So if we multiply it by 5 dinars per dollar, the answer will be something dinar square per dollar, which is nothing. So what we should do is we should actually divide it by 5 dinars per dollar. So normal mathematics says that if you convert the division sign to the multiplication sign, it will become the reciprocal. So in this, the dinar and dinar will be cancelled and we are going to get $42 million. So the rate is actually 5 dinars per dollar. Okay, so let's get back. And we were discussing that $13 million is actually the post acquisition profit. But if we see, this post acquisition profit is not only the profit, this also includes the impact of the exchange rate differences. So this 13 million actually has both the exchange rate, the post acquisition profit plus the impact of the exchange rate. So what we are going to do, we need to calculate the breakup of $13 million, that how much is the exchange gain and how much is the profit into this. So what we do is we actually take the increase in the profit. If we try to calculate the post acquisition profit, that was 10 million dinars as the profit. And if we divide it by the average rate of 4.5, we are going to get the post acquisition profit in terms of the dollar. So let's use a calculator, and 10 divided by 4.5 is going to be 2.2222. So let's use it to one decimal place. So $2.2 million is the profit out of this 13 million. So this 13 has a profit after tax of 2.2 million, and remaining impact is the exchange gain on the translation of subsidiary, which is $11.8 million. So this is how actually we calculate the value of the exchange gain and the profit after tax. Okay, it's 10.8. It's 10.8. Let's correct that. Okay, so now this 13 million actually has a profit share of two people. Out of this, parent has a profit share of 80% and NCI has a profit share of 20%. So 80% of 13 is going to be how much? 10.4, and 20% is going to be 2.6 million of the NCI. Laiba is saying why we took 180 share capital at the acquisition, because Laiba, the share capital was 180 of the subsidiary and it will be the same at the date of acquisition, and the balance sheet, it will never change in our course. It will never change in our course. So that is why we have taken the same. So any confusion so far, you can ask quickly. Salim Raza is saying this 10 million is the difference between at acquisition return earning and at balance sheet return earning. Exactly, Salim, you're right. Okay, so now let's move further and we are going to solve the working number 2, which is of goodwill. Now, goodwill is a bit complex working again. Let me add one more thing into the question, that the goodwill has impaired by, let's say, 10%. Goodwill was impaired by 10%. So what will happen in this, if we calculate working number 2 as goodwill, we are going to write first the cost of acquisition, we are going to add the fair value of NCI, and then we are going to deduct the fair value of the net assets. The first thing is that we need to calculate the cost in the cost NCI and the net assets, which means the goodwill, in the foreign currency. So the value of the NCI given in the question was how much? 60 million dinars. And the cost was given in terms of dollars, $40 million. So what we are going to do, the cost was $40 million multiplied by the $5 exchange rate, which will give us a value of 200 million dinars. The NCI was 60 million dinars, so we have got the cost total of 260, and the net assets at the date of acquisition were 210. In terms of dinars, it was 210, this value. We are using this, and this will give us a goodwill, which is going to be 50 million dinars. And now we are going to apply the exchange rate onto this. Now, which rate should we apply? Acquisition date rate or the balance sheet date rate? Showman is saying acquisition, Ali Khan is saying balance sheet, Salim is saying both. Okay, a lot of quick answers from you people. I cannot read all. Basically, ideally, the goodwill would have been calculated at the acquisition date when the rate was 5. So this means that the goodwill was originally $10 million. The goodwill was originally $10 million. But if I go back to the question and if we see, when we are going to prepare the group accounts, we are going to add 100 plus 200 divided by the closing rate of 4. Similarly, the current assets will also be consolidated at the closing rate. The liabilities will also be consolidated at the closing rate. So if we are calculating the goodwill at the rate at the date of acquisition, that will become inconsistent. So we even need the goodwill at the closing rate of 4. So what we do is first we calculate the goodwill at 5, then we are going to retranslate it again at the rate of 4, at the balance sheet date. So it is going to be divided by 4. But as the goodwill has been impaired by 10%, this means by the balance sheet date, the goodwill was impaired by 5 million and it was 45, which needs to be divided by the 4 now. So it is 11.25. Abdul Qadir, thank you. Shivon, thank you. So now we have got the value of the goodwill at both the dates, at acquisition and at the balance sheet date. This means that in total we have a gain of $1.25 million. But again, this gain includes two impacts. This has an impact of impairment loss, and this has an impact of the exchange gain. So if we want to calculate the breakup of the exchange gain and the impairment loss, what we are going to do, we are going to divide the $5 million by the average rate to get the impact of the loss in P&L. So it's 1.1. Thank you, Siobhan. So 1.1 is the loss, impairment loss, which is going to be a negative 1.1. Because it's a loss, it is going to be a negative 1.1. And this means the exchange gain is 1.25 minus 1.1. It will be 1.25 minus 1.1, which is going to be 1.25 plus 1.1. So the exchange gain is going to be 2.35 in this case. Okay, some people are asking me to repeat the impairment loss. Basically, let me repeat it on a new screen so that it's more understandable. The goodwill at acquisition was 50 million, and we have impaired 10% of that, which is 5 million. So the goodwill at balance sheet is now 45. I'm repeating the goodwill calculation, Laiba, the goodwill impairment calculation, in fact. So now we should be dividing 5 by 50. We are going to divide 4 by 45 because this is at acquisition, this is at balance sheet date, but the 5 was during the year. So this means that we should be applying the average rate of 4.5 onto this. So the goodwill has been impaired by 1.1, which was previously 10 and now it is 11.25. Getting the point, everyone? Laiba is saying that I'm asking the start of the goodwill. Okay, Laiba, let me tell you that again. RD Chaudhary is saying, so we can calculate exchange gain or loss on goodwill by taking difference. Yes, exactly, RD Chaudhary, you're right. Ali Kani is saying, wouldn't the gain be distributed? The loss should be distributed. Yes, Ali Kani, that will be distributed. Salman is saying, please ignore them. Okay, the break will be at 9:30, Tamina. Okay, now let's get back. So now we have got that the value is 1.25, the gain or the loss on the goodwill. This again belongs 80% to the parent and 20% to the NCI. So it is going to be 2.5 and it is going to be, sorry, it will be 0.25 and this is going to be 1. Sridhar is saying the value of 10.4. Yes, Sridhar, this includes the value of both profit and the exchange gain or loss. This includes both. Okay, so this is how we actually calculate the working one and working two. Now let's solve working number 3 so that we can quickly move on towards the past paper question. My original target was to complete the foreign subsidiary before 9:30 so that after the break we can continue with the cash flow. So if we talk about working 3, which is the NCI, we should be starting the value from the fair value of NCI, and we're going to add the share of profit from working 1 and the share of profit from working 2. But the fair value of NCI was given in dinars, which was 60 million dinars. Laiba, we are short of time, so it's a request if you can recheck the value of the goodwill in the recorded session because we also have to complete the target for today. So now what we are going to do, we are going to divide this 60 million by which rate? Acquisition rate or the balance sheet date rate? Mohammed Saqib is saying 5, Ali Kani acquisition, everyone is saying acquisition almost. So yes, it will be divided by the rate at the date of acquisition, which was 5. So this is going to give us a value of 12 million, and NCI's share from working 2 is a positive 0.25, and NCI's shares in working 1 was a positive 2.6. So if we add 12, 2.6 and 0.25, we are going to get a value of 12 plus 2.6 plus 0.25. So this is going to be 14.85. Now the last working that we are going to solve is working number 4, in which we are going to calculate the retained earnings as well as an other components of equity. The exchange gains and losses will go to other components of equity, and the post acquisition profits will go to the retained earnings. So first we are going to write the value of the parent and then the value of share of profit in subsidiary from working 1 and working 2. Okay, so now let's check the value of parents retained earnings, which was 55. We're going to use this in the retained earnings. There was no OCE of the parent, and now we need to write the parent's share of profit from working 1 and working 2, which was actually 10.4. But the share of parent in profit after tax into 80% will go to retained earning, and 10.8 into 80% will go to OCE. The profit 2.2 into 80% will go to retained earnings, and the exchange gain of 10.8 into 80% will go to the OCE. Are you people getting this? Mohammed Tala is saying why exchange gains and losses go to OCI. Mohammed Tala, the reason is that if I have a subsidiary, I am not going to realize the exchange gains and losses until I sell the subsidiary. So these will be realized when I sell it, and I have no intention to sell it. So that is why we call this an unrealized gain and we take it to the OCI. Okay, so Sabah is saying to repeat. Actually, this is the gain of 2.2 and 10.8 which we had calculated, and the parent will have a share of 80% in both of them. So 2.2 into 80% is 1.76 and 10.8 into 80% is 8.64. Thank you, Mohammed Saqib. So if I go down, I'm going to say that the realized profit was 1.76 and unrealized profit was 8.64. Similarly, we need to do the same in working two again. In working two as well, we are going to take share of 80% in the impairment loss, which is going to be a negative 0.88, and 80% in 2.35, which is going to be 2.35 into 0.8, which is 1.88. Okay, so let's write it down. It's negative 0.88 and a positive 1.88. So if we calculate the total, it is going to be 55 plus 1.76 minus 0.88, which is going to be 55.88. And in OCI, it is going to be 8.64 plus 1.88, which is 10.52. Ashita is saying, so in working four, we take only parent share. Yes, exactly, Ashita. NCI's share we have taken to working 3 and parent share will be taken to working 4. Mohammed Thai is asking that when we dispose of the foreign subsidiary, then gain and loss will be transferred to P&L. Yes, exactly, Mohammed Thai. We are going to do this in one of the past paper question immediately after this one. So if we go back to the question, actual question, now we can actually put in the values, which is 100 plus 200 divided by 4, which is going to be 150. For the non-current assets, there's no investment in the consolidated financials. And the goodwill was how much? The goodwill was 11.25. We are going to take the value at the year end, 11.25. And the current assets are going to be 17.5. So if we calculate the sum, it is going to be 150 plus 11.25 plus 17.5. So this is going to be 178.75. On the balance sheet side, the share capital will be 90 million. Retained earnings will come from working 4. OCE will come from working 4. NCI will come from working 3. And the sum of the liabilities is going to be 7.5. So let's write down the retained earning, OCE, and NCI. The NCI was 14.85. The retained earnings were 55.88 and OCE was 10.52. So now let's calculate the total. It's 90 plus 55.88 plus 10.52 plus 14.85 plus 7.5 will give us 178.75. So this is how we have balanced a balance sheet of the foreign subsidiary. Yes, Tha, you are right. Mohammed Sagib is saying bravo. Jagmeet is saying amazing. Thank you. Salman is saying cheetah. Oh my God. Okay. So this is a complete process of how actually we take up the foreign subsidiary completely. But in the exam, you will not be supposed to prepare the entire balance sheet, but the examiner can ask any part of the balance sheet. Like the examiner will focus more on these workings rather than just adding the balance sheet. Yes, Ayodeli G, a difficult name. You can take the snapshot. Let me zoom out it a bit. Although I will be sharing the PDF file as well. So if you want to take a snapshot, you can take it. This is the later part of the question. You will have to take a lot of snapshots. Salman, I will share the PDF file today. Before leaving the ACC office, I will share the PDF files. Where will you be sharing the presentation? Tamina, the presentation will also be shared on the group. So far, we have created 3 different groups because of the excessive requests from the students, and most probably I will be creating the 4th one as well because the 3rd is almost full. So once the group 3 is full, we will move towards 4 and I will share the answers in the presentation on all of the groups. So there's nothing to worry. Alistair is saying that in the suggested answer, they call it a translation reserve. Yes, basically, Alistair, what exactly is OCE? Let me explain you this. Normally in a balance sheet equity section, we write the share capital, retained earnings, revaluation reserve, share premium, other reserve, other equity reserve, asset replacement reserve. There are a lot of reserves. So rather than writing them separately, we call all of them other components of equity. So the other components of equity means a separate reserve. So if we write a translation reserve separately, or we write OCE, this means the same. So OCE is not a reserve. This means creating a separate reserve. Getting the point, everyone? OCE actually means creating a separate reserve. OCE itself is not a reserve. It's other components of equity, a separate reserve. Okay, now let's move towards the past paper question. Yes, Alistair, even if you are accumulating in the OCE, it is also correct. The examiner writes it separately so that it's more understandable to the students. But from the marking perspective, if you add the translation reserve in the OCE, you are still going to get full marks. The examiner only writes it separately for you people to understand it better. Okay, so now let's open the past paper question of Carbies. You people can download the question in the uploaded documents. And I'm meanwhile opening in my laptop. Mohammed Naseem is saying, please show the answer. Mohammed Naseem, the answer is too long. Let me open in a while. This is the question, Carbies. Everyone can open it quickly. Meanwhile, the students who want to get the snapshot can take it. This is the working one. We can take separate workings actually. Working one snapshot quickly, everyone. Working one snapshot. SBR we need to open June 2019. June 2019 hybrid paper. Now this is working 2 and working 3 on a single slide. And then we have working 4, quick snapshot. Shridhar is saying that, sir, what rate we will we use if the closing and opening rates are given? Actually, closing means the balance sheet date rate, reporting date rate, and opening will normally be the acquisition date rate. Salman, the lecture recording will be available tomorrow morning probably. Okay, so now let's start reading the question. This is the question by the name of Carbies. Let me start the question from the requirement. And surprisingly, if we see, this was a complete 30 marks question from consolidation. Normally in question one, we see a hybrid question with consolidation and the standards. But this one was a complete 30 marks consolidation question. So let's read the requirement. It says that prepare an explanatory note, which means a theoretical note, for the directors of Carbies, which addresses the following issues. So we are starting from bullet number 2 because the part 1 is something relating to IS 21. Cindy is saying which exam paper? Cindy, March, June 2019. We are opening March, June 2019 exam. So the question says that Ashita, IS 21 was asked for approximately 25 marks in June 19. So I would say that IS 21 is not very much important, but it can be up to 5 to 7 marks in the exam, but not beyond that, ideally. The question says that we have to show a calculation of goodwill on the acquisition of Bike Light and what balance would be at 30th September 2026 immediately before the disposal of shares. So we need to write the goodwill at acquisition and at 30th September 2026. Your answer should include a calculation of exchange difference on goodwill for the period 1st January 2026 to 30th September 2026. So for 5 marks, we need to calculate the goodwill. Sardar is saying, how do we download June 2019 question? Sardar, in the handout side of the session, you have all of the handouts available over there. You can click the handout. It will open directly. No, Merrick, we are solving just the question number 1 right now. Okay, so now let's move to the question, and the question has given us a background, but right now we don't have time to read the background. The second paragraph relates to requirement A part 1, so we are directly jumping on this part of the question to calculate the goodwill. The question says that Carbis paid 100 million dinars for 80% of the ordinary share capital of Bike Light on 1st January 20x2. So this is the date of acquisition when we have acquired. The net assets of Bike Light at this date had a carrying amount of 60 million dinars. So we have paid 100 million dinars. We have got the net assets of 60 million, but this is the carrying amount. The only fair value adjustment deemed necessary was in relation to building, which had a fair value of 20 million dinar above its carrying amount. So this means that the net asset should be increased from 60 to 80 because we are increasing the building by 20 million. So the net assets at acquisition will be $80 million now. And a remaining useful life of 20 years at the date of acquisition. So we should be depreciating the building as well with a value of $1 million every year. Carbis measures non-controlling interest at fair value for all acquisitions. So this is a full goodwill method. And the fair value of 20% interest was estimated to be 22 million dinars at acquisition. So this is the fair value of the NCI. So we have got the cost, we have got the net assets, we have got the NCI. We can simply calculate the goodwill. Then it says due to relatively poor performance of Bike Light, it was decided to impair goodwill by 6 million dinars. So the goodwill has also been impaired. So this is quite a similar question of what we have just solved. During the year ending 31st December 20x5, so this was impaired in 20x5, which is 4 years after the date of purchase. How 4 years? From 1st January 20x2 till 31st December 20x2 will be the year 1, 20x3 year 2, 20x4 year 3, 20x5 will be year 4. So after 4 years, the goodwill got impaired by 6 million. The question says that the rates of exchange between the dollar and the dinar are given as follows. So we actually need the rate at the date of acquisition for the goodwill. We need the rate at both the year ends, and we need the average rate to get the value of the goodwill. So that this is the actual paper of March 2019. Actually, the June 2019 paper has not been published by ACCA. So now let's solve this question on a different sheet. And we are going to call this question of Carbis, Carbise. Okay, so now if we are calculating goodwill in the working number 2, what we're going to do, we are going to write the cost of acquisition, which the question gave as 100 million dinars. We are going to add the fair value of the NCI, which was given as 22 million dinars. So we've got a total of 122. And the fair value of net assets was 60 of the carrying amount plus 20 of the fair value adjustment. So we have got the goodwill of $42 million at the date of acquisition. So this is 20x2. Now the goodwill actually got impaired in 20x5, and the question wants us to calculate the goodwill at 20x6 as well. So we are going to calculate goodwill of 20x2, 20x5, and 20x6. So now the goodwill got impaired by 6 million, and on 31st December 20x5 this became 36 million, which was the same at the year end of 26 as well. Now what we need to do is simply divide this by the rates of the year ends. Ali Raza is saying that we translate goodwill every year. Yes, Ali Raza, we do. But the question wanted us, if I go to the question wanted us the goodwill at acquisition and at 30th September 20x6. So ideally, we just need 20x2 and we just need 20x6. Nothing else is required. But the question also said your answer should include a calculation of exchange differences for the period 20x6 to 1st January 20x6 to September. So for that, we had to calculate 20x5 as well, so that we can give the exchange differences between these two periods. That is why we are calculating 20x5. Otherwise, even the 20x5 was not required. Yes, Jawad, if the goodwill would have been impaired in 20x4, we should have used the average rate of 20x4 in that case. So if I apply the exchange rates, it was 0.5 on the acquisition, 0.38 and 0.35. So it's 0.5, 0.38 and 0.35. So this will give us the value of the goodwill in every year. So if I use the calculator, we're going to say it's 42 divided by 0.5, which is going to be 84. 36 divided by 0.38, which is 94.7, and 36 divided by 0.35, which is going to be 102.9. Okay, thank you everyone. I just saw that you people were typing over there. So now we can actually calculate the value of the goodwill. The goodwill the question was asking was at the date of acquisition, it's 84. This was asked by the question. The question asked the value at the balance sheet date and the exchange differences. So for that, we need to calculate this value. The difference is actually how much? 102.9 minus 94.7, which is going to be 8.2. So 8.2 is the exchange gain. This is entirely exchange gain. There's no impact of the impairment in this. And if we take 94.7 minus 84, this is going to be 10.7. But in 10.7, we have two values. One is the impact of the impairment loss, and the other is the exchange gain or loss. So if we want to calculate the impact of impairment, we need to divide 6 by the average rate, and the average rate was 0.4 in the question. So if I divide it by 0.4, I'm going to get a value of how much? 6 divided by 0.4 is going to be 15. So impairment loss is going to be 15 million negative. Ashita is saying, sir, how is goodwill same every year? Ashita, because it is not being impaired. It's the same in 20x5 and 20x6 because it has not been impaired further. Mohammad Naseem is saying, sir, what about the depreciation of building? Mohammad Naseem, the depreciation is charged in the P&L. It has no impact on the goodwill. So now the exchange gain or loss is going to be 15 plus 10.7, which is going to be 25.7 million of the gain. So these two values are going to be the exchange gain or loss in these 2 years. So this is how we have solved the first part of the question, which was asking us for the 5 marks to calculate the goodwill at acquisition, at the balance sheet date, and the exchange difference from January till September, which we have just calculated as 8.2. So the question's requirement was actually these highlighted values. The question requirement was actually these three values: goodwill at acquisition, goodwill at balance sheet, and the exchange gain or loss. Arbaz is saying, sir, please explain the entry of investment debit P&L credit of 25.7. It's basically goodwill debit and OCI credit by 25.7. Arbaz. The exchange gain or loss will be taken to OCI of 20x5. Alistair is saying, sir, can you please show how to divide goodwill further onto parent and NCI portion? Alistair, that's pretty simple. You just need to take the percentage, relevant percentages, like 15 will be divided between how much percentage it was? It was 80-20. So this is how we are going to break 80% of 15, 80% of 25.7, 80% of 8.2. This is how we are going to divide. Okay, so now let's move on to the next part of the question, which actually says an explanation of your calculation of goodwill. Now this requirement says that we need to explain the calculation and the treatment of exchange differences on goodwill. The treatment of exchange difference is that it should be taken to the OCI, the 25.7 and 8.2 both, and will be divided between parent and NCI, and will also be shown in the OCI each year. I'm going to write the answer, don't worry. And then it says in the consolidated financial statements, you do not need to discuss how the disposal will affect the exchange gain or loss. So it's a quick 4 marks question theory. Let's quickly write this and then we'll take a break. And after break, we are going to solve the remaining parts of this. So I'm going back to the worksheet and the battery is low. Let me use a charger. Okay, so let's start writing about this. It is still saying, I was checking my battery. Okay. Okay, so let's write it down. And we are writing the question of carbies now. And it's part A2. So let's read the question. Before starting, it was asking the explanation of how to calculate the goodwill. So we can say that while calculating goodwill using the full goodwill method, the cost of investment is added in the fair value of NCI before deducting the net assets at the date of acquisition. The goodwill is initially calculated in foreign currency but then retranslated into local currency at the exchange rates on the relevant dates. The exchange gain or loss on goodwill is recorded in OCI during each year and accumulated in the retranslation reserve in the statement of financial position. So this is the simple answer of the question. It was asking how to calculate goodwill. We have mentioned how do we calculate goodwill till over here. This was how do we calculate goodwill, and then it said how to treat the differences. We have mentioned how to treat the differences. This goes to OCI and in the retranslation reserve. The exchange gain or loss is divided between parent and NCI in their respective shareholding percentage. Yes, Sardar, it is the same. So this is how we had to actually explain the answer, and I hope it is not very much difficult. A lot of students face the difficulty in writing down the answer, but uh, if you're used to of writing the answers frequently, that hesitation will be covered through that. Yes, Kabir, I will be sharing the short notes on every standard, but after completing the webinar session, because already I'm having a crash course in the morning of approximately 8 hours, and after that I have to conduct a webinar of 3 hours, and so it's quite hectic right now. So once the webinar is completed, I will share the summaries altogether. Yes, Tamina, if you write this paragraph, you're going to get full answer. Manik, this is a difficult question, actually. Okay, so let's take a break. And if somebody wants to take the snapshot, this is the snapshot. We are going to have a 10 minutes break, 10 to 15 minutes break, and then we are going to continue back. So see you if after a short break. Okay, everyone, welcome back. Let's continue the session. And previously, we had solved the requirement part A2 and part 3. Now, let's move on to the requirement part B, where the question says that explain why exchange differences will arise on the net assets and the profit or loss of bike light each year. Why exchange differences will arise? Because we are retranslating at the exchange rate at each year end. So because the exchange rates are changing, this will result in the exchange gain or loss. So this is the simple answer. And how they would be presented within the consolidated financial statements. They will be presented in the other comprehensive income in the P&L and in the retranslation reserve in the statement of financial position. Okay, Rida, I will add the remaining students before sharing anything. Your answer should include a calculation of exchange differences which would arise on the retranslation of bike light excluding goodwill in the year ended 31st December 20x6. So we need to perform the calculation of exchange differences. Excluding goodwill means exchange differences arise only on two things, net assets and goodwill. So excluding goodwill means the question wants us to calculate the exchange differences on the net assets, which means the question wants us to calculate working number one actually. So if I go back upwards, this is the area from where we are going to solve the question. It says Carby sold its entire shareholding, equity shareholding in Bikelight on 30th September 20x6 for $150 million. So our year was starting on 1st January and we have sold it on 30th September. This means 9 months after the start of the year, and we have sold it for 150. Further details relating to the disposal are as follows, in which we have the carrying amount of lights net assets at the start of the year. The carrying amount was 48 million dinars. Bike lights loss for the year ended 31st December 20x6 was 8 million dinars. So by using these two values, we can calculate the net assets at the year end. Cumulative exchange gains on 1st January was 74.1 million, and the non-controlling interest at the start of the year was 47.8 million. So now using these values, we are going to calculate the working number one. So let's write down it. And now we are solving basically the working one, which is the net assets. And we need the net assets we have on 1st January. So I'm writing 1st Jan 20x6, and then we need to write it at 30th September 20x6. Now the carrying amount as per the question at the start was 48, and the loss according to the question was 8 for the year ended 31st December 20x6. This means this is a loss for the entire year. So we can say that the net assets was 48 million and value at the balance sheet date is going to be 48 million minus 8 into 9 by 12, because 8 million is the loss for the entire year. So 9 months loss is going to be 6. So this is going to be 42 million. But do remember that this is the carrying amount. So we also need to incorporate the fair value adjustment of 20 million. Do you remember that? The fair value adjustment was of $20 million relating to the building, which had a life of 20 years. This was all about in 20x2. So this means by the start of the year, $20 million of the fair value adjustment would have been depreciated for 4 years. So this will give us a net book value of $16 million. So this means that the net assets at the start of the year was 64, and a further depreciation of 1 million into 9 by 12 will be charged till the date of disposal. So 1 million into 9 by 12 will be 0.75. So if we charge a depreciation of 0.75, the net value is going to be 15.25 at the date of the disposal. So this way we are going to get a value of 42 plus 15.25, which is 57.25. So these are the net assets at the date of acquisition and at the date of disposal. Now we need to apply the exchange rates onto these dates, which was how much? 0.38 and 0.35. So divided by 0.38 and divided by 0.35 will give us the net assets on these two dates. So 64 divided by 0.38 is 168.4, and 57.25 divided by 0.35 is going to be 163.6. So this means that we have a loss of 5 point, let's check, 168.4 minus 163.6, it's a loss of 4.8. So now amongst this loss we have two values. One is relating to the profit and the second is relating to the exchange gain. So if we need to calculate the impact of profit, we are going to say that it was a loss of how much? 64 minus 57.25. So it was a loss of 6.75. And we need to divide it by the average rate, which was 0.4. I think so. Yes, it was 0.4. So divided by 0.4 will give us a value of 16.9. So 16.9 is the loss. So this will result in an exchange gain of how much? 4.8 minus 16.9 means it will become a plus 16.9, which is going to be a gain of $21.7 million. So this is how we have calculated the exchange gain on the net assets of the company. Okay, there's one more problem, that we have incorrectly used the average rate of zero point 0.4. Actually, the average rate which was to be used was 0.37. So let's correct that first, because this rate of 0.4 was in 2015. So let's check the correct rate. It's 0.37. So 6.75 divided by 0.37 is going to be 18.2. It's going to be 18.2, and this is a negative 18.2. Any confusion still here? And now we need to check the exchange gain. So 18.2 minus 4.8 is going to be a value of 13.4 as the exchange gain. Nabia is asking that how do we know if we need to take 0.37 exchange rate and not 0.35? Basically, Nabia, anything which is for the year will be used, will be translated at the average rate. So this 6.75 was a loss for the year, so we have used the average rate. And because the loss was in 20x6, that is why we have used the average rate of 20x6. Yes, Saud, 18.2 into 80% will be of the parent and 20% will be of the NCI. So we can even actually write it down. So the profit after tax was 18.2 and exchange gain was 13.4. This was the total. So we can calculate the value, the share of the parent in the NCI. So 18.2 into 0.2 is going to be 3.64 relating to the NCI, and 18.2 into 80% relating to the parent. So it is 14.56. Similarly, 13.4 into 20% is going to be 2.68 positive, and 13.4 into 0.8 will be 10.72 positive. So negative 3.64 plus 2.68 is going to be a negative 0.96, and 14.56 negative 14.56 plus 10.72 is going to be 3.84 negative. So this is the total. Ashita is saying, sir, don't we take 4.8 share also in parent NCI? Basically, Ashita, if you take the share in 4.8, 80% and 20%, it will be the same as these ones. Let me show you. 4.8 into 80% is going to be 3.84. This is the 3.84 that we have used over here. So it's the same. If uh, if we use the total to calculate, or if we use the breakup to calculate, it means the same. And 4.8 into 20% is the same as 0.96. So either take the total or take the breakup. It's the same. Mohammed Naseem is saying, sir, how is it an exchange gain? Basically, Naseem, if we see, the profit was negative 18.2, which was reduced to 4.8 because of exchange gain or loss. So this means the negative value is reduced because of an exchange gain. Getting the point? The value of the loss has reduced because of the exchange gain. Cindy is saying, can you go over how we split profit and exchange gains? Okay, Cindy, this is how actually we are going to calculate the impact of the profit. Movement in the net assets divided by the average rate will give us the impact of the profit, which is taken to the P&L, and negative 4.8, negative 4.8, let me use a scientific one, negative 4.8 minus a negative 18.2 will give us a value of 13.4. Getting, Cindy? Mohammed Naseem, are you getting this point? Mohammed Naseem is saying yes. Okay. So now what was the question's requirement? Let's go back and check it out. The question was asking, Your answer should include a calculation of exchange difference which would arise on the translation of bike light. So we have got the value for that. So the exchange difference is actually these 13.4 in total, 2.68 for the NCI and 10.72 for the parent. So this is how we have completed part B, except for the explanation. You can write the explanation on your own so that we have some time for the cash flow as well. Now let's discuss part C. Part C is of 3 marks, which says calculate the group profit or loss on the disposal of bike light. So now we need to calculate the profit or loss. So if we go back and we write part C, this is actually part C of Carby's. So if we are writing the entry for the disposal, we should be writing the bank, the cash that we have received. Arbaz is saying this is very, very difficult question. Yes, Arbaz, it is, no doubt about that. It's March 2019 exam question. Apart from that, to de-recognize the subsidiary, we need to debit the NCI, we need to credit the net assets, we need to credit the goodwill. So this is how we actually prepare the entry for the disposal. And there's one more thing that we need to write actually, which is when a subsidiary is disposed of, its exchange gain and losses are transferred, recycled to the P&L. So whatever the exchange gain is, it would have been a credit side of the reserve, retranslation reserve, which we are going to debit in the entry to get the final gain or loss on the disposal. So the retranslation reserve is also eliminated when we are talking about a foreign subsidiary. Now we just need to put in the values. If I go back, the carrying value of the net assets was 163.6 at the date of disposal. So we can say 163.6 at the date of disposal. Apart from that, if we check the value of the goodwill, it was 102.9 at the date of disposal. So we are going to keep the value of the goodwill as 102.9. And now we need to calculate the value of the NCI and the retranslation reserve. So we need to calculate these two values. For NCI, we need to prepare the working number 3, where we are going to write the fair value of NCI, and we need to add the share of profit from the working 1 and the working 2 to get the value of the NCI. Nimra is saying, can you please repeat this translation reserve debit thing? Basically, Nimra, we used to call the exchange gains and losses an unrealized because we had no intention to dispose of the subsidiary. But now, when we are disposing the foreign subsidiary, this means all gains and losses should be realized now. So in case of foreign subsidiary, the retranslation reserve is recycled to P&L at the time of disposal. That is why we are debiting the retranslation reserve. So let's check the fair value of the NCI. The fair value of the NCI was, if we refer to the goodwill, it was 22 million. And the share of NCI is going to be 10.7 into 80%. So 10 point, in fact, no, not 10.7. It is going to be 8.2 into 80% because we are calculating the gains and losses of 2016 only. So 8.2 into 20% for the NCI is going to be 1.64. So 1.64 from working 1, and from working 2, NCI's share was negative 0.96, and the fair value of NCI was 22, but 22 is in dinars, so we need to divide it by the rate. Okay, let me write the details so that it's more easily understandable for you people. Because the value of the NCI is at acquisition, which was 20x2. So we need to add the share of profit from working 1 and working 2. In fact, if I refer back to the question had given us the NCI at the start, this one, which was 47.8. So we don't need to start actually from the acquisition. We can simply start from 47.8. So if we use a calculator, it is going to be 47.8 plus 1.64 minus 0.96. So we are going to get a value of NCI of 48.48. So this is going to be used over here. So because the question had already given us the value, opening value of the NCI, that is why we actually use that directly. Are you people getting this? If there's any question you can ask. Yogesh is saying, sir, NCI share in goodwill exchange gain or loss should be cumulative or for the year. Yogesh, basically, if we are starting from acquisition till the balance sheet, we should take accumulated. But because the question had given us the opening value, and from opening till balance sheet date, we are only going to take for the year. So this depends that from where are we starting. If we are starting from acquisition, we should take all the values. If we are starting from the opening, we should just incorporate the for the year values. Mohammed Saqib is asking 47.8 dinars or dollars. Saqib, if I refer back to the question, it's NCI 47.8 million dollars. So we do not need to convert it using the exchange rate. It's already in dollars. Salman is saying, sir, time is short. Please wind up. Go. ठीक है. Okay. Tasbih is saying, sir, screen is lagging. Actually, when I change the screen, there will be a short lag. Okay, now the value that is left is the retranslation reserve. And if you see, all this effort that we are doing is only for 3 marks. The NCI that we are calculating, the exchange reserve that we are calculating, and in return, we are only getting 3 marks. So sometimes in the exam, there will be few marks which will consume a lot of time, a lot of effort, and it won't be too much of the mark scoring. But obviously, you won't know it beforehand. Once you invest all the time, only then you are going to know that, okay, this was only of 3 marks. So what you can do is, if anything is consuming a lot of time, just go and check the marks. If the marks are too less, you can ignore those values and go further. So now we are going to calculate the retranslation reserve value. Again, for the retranslation reserve, we need to get the opening value, and then we are going to get the value exchange gain or loss on the net assets and exchange gain or loss on the goodwill, which is again working 1 and working 2. So the opening value was given in the question, which was 74.1. So we can use 74.1 over here. Now we need to get the value from working 1 and 2. So if I go back onto the value of net assets, we can see that the exchange gain relating to parent was 10.72. This is the exchange gain that belongs to the parent. So we need to add 10.72 for the net assets. It's retranslation reserve. I wrote it RR as a short form. We can call it retranslation reserve or OCE. It's the same. Anand is asking that, so once we ignore a question, can we come back and write it again? Yes, you can, Anand. Okay, now if I go back onto the working of the goodwill, we had got an exchange gain of 25.7 over there, out of which 80% belongs to the parent. So 25.7 into 80% is going to be 20.56. This is the exchange gain that belongs to us. But this is a gain that is from 20x2 to 20x5. So 8.2 into 80% is the one that belongs to the current year. So 8.2 into 80% is going to be 6.56. So this is the value that goes to 20x6, and this is the value that goes to 20x5. So 6.56 is the value that we need to add over here. Okay, so far we have got the values. So if we calculate the sum of all these, this is going to be 74.1 plus 10.72 plus 6.56. This is going to be a total of 91.38, which we are going to debit over here, and this will give us the balancing figure of the exchange gain or loss. So can you calculate the balancing figure now? $23.36 gain or loss? Is it a gain or a loss? Seems to be a gain. 23.36. So this is how we have solved a complex question for only 3 marks. So in exam, you are not supposed to go into too much complicated calculations if they are time consuming. Okay, so now we are done with the question 1 of June 2019 attempt. So there's one more question of P2 December 2015 by the name of Bubble. You can also find this in BPP or Kaplan exam kit. So you can solve this as an homework. But Carby's is one of the questions that itself is quite sufficient if you want a comprehensive understanding of the topic. Salman is saying, what is the probability? Salman, according to me, either the exam is going to be a step acquisition or it is going to be a cash flow. So these two topics are the most important ones for your September attempt. Or it may be an income statement question as well, but these two are comparatively more probable. Onam is saying that, sir, is there anything more to learn in foreign subsidiary? Onam, this is the entire thing that was supposed to be learned, because this was a quite comprehensive question covering all types of important areas. Okay, so it's 10:22 now. Let's move towards the cash flow statements. Okay, now we are starting the topic of the cash flow statement. Now, when we talk about a cash flow statement, there are total three headings: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities that needs to be incorporated. So we need cash flow from investing, financing, and operating activities in the cash flow statement. In investing activities, we normally talk about the non-current assets and the investment incomes. These are the two areas that we discuss in the investing activities. And in financing activities, we actually talk about the equity and the non-current liability section of the balance sheet. So if we talk about the cash flow from operating activities, we started from the profit before tax and we write down the adjustments. We try to reverse all of the non-cash items and non-operating items. These are the two items that we usually remove from the cash flow from operating activities. So anything which is added will be deducted. Anything which was previously deducted is going to be added. Same goes for the non-operating activity. Now, what exactly is a non-operating activity? It's a bit congested. Let's make some space. Profit before tax, adjustments. So let's say, for example, depreciation. Depreciation is a non-cash expense. So we should be adding it back because we have to remove it from the cash flow statements. Similarly, any amortization expense, any impairment expense, all these are type of non-cash expenses, so we need to add it back. Similarly, if we talk about IES 19, in IES 19, the service cost component is an expense which we record in the P&L. The remeasurement component is something that we take to the OCI, and contribution is the amount that we pay to the fund, and benefits paid is the amount that the fund pays to the employees. So these are four elements which we talk about when we talk about IES 19. So in this, service cost component is an expense which is non-cash, and the cash that we have paid is the amount of the contribution. So what we do is we actually add the service cost component in the cash flow statement, and in return we deduct the value of the contribution paid to incorporate the non-cash impact. Getting the point so far? That the objective is to remove any sort of a non-cash item from the cash flow statements. Similarly, interest income or a dividend income would obviously be in the cash form. But the problem is that we want cash flow from the operating activities, and earning the interest is not an operating activity for the company. So we should remove this from the profit and loss so that we can come to the cash flow from operating activities. So all these values were the examples of non-cash items. And now I'm going to give you some examples of non-operating items. So interest income is an income in the form of cash, but our objective of the business is not to earn the interest. Our business may be to sell goods, to provide services. So interest income, dividend income, rental income, all these are sort of non-cash, non-operating income. Similarly, if we have any gain or loss on disposal, that gain or loss on disposal is also a non-operating activity. Our objective is not to earn by selling the assets. Our objective is to earn by selling goods and services. So selling any asset and recognizing a gain is actually a non-operating gain or a non-operating loss. So we should also reverse this while we are making the cash flow from the operating activities. Similarly, if we talk about the step acquisition that we had just discussed, in step acquisition we assume that the old investment is sold at fair value, let's say 15 million, and the investment is credited by its carrying amount, let's say 10 million, and we take the remaining amount of 5 million as a gain to the P&L. Now, if we see this 5 million of the gain, according to the assumption of step acquisition, is also a non-cash gain, So we should also adjust this when we are preparing the cash flow statements, but that will fall in case of the non-cash items. So that is also a gain or loss on disposal, but according to the assumption, that is the gain or loss. Sardar is saying service cost and contribution is not cash item. Sardar, service cost is not cash, contribution is cash. So if we have recorded an expense of 10 million, so we add it back so that it gets cancelled out. And in return, we deduct the amount of contribution because that is an amount which was the cash outflow. So adding the service cost, deducting the contribution actually adjusts the non-cash impact. George is saying interest income isn't based on accrual concept, so non-cash item, correct? Yes, George, if the interest income hasn't been received in cash, then it will be non-cash. But normally, if you are receiving the interest income, still we deduct that because that is a non-operating activity. Mohammed Naseem is saying, I cannot see your question, Mohammed Naseem. I don't know why. It is showing that you are asking something, but I'm not able to see that. Yes. Ashida is saying, sir, it's so confusing. How do we know what are non-operating and what are non-cash? Ashita, you don't need to check what is non-cash and what is non-operating. Whenever the question tells you something, you have to identify from that statement that what is cash and what is non-cash. And if you have strong grip on the accounting standards, only then you can identify it better about non-cash and non-operating activities. Vishal is saying, sir, please repeat step acquisition, and Salman wants to repeat the contribution paid. Okay, let me repeat again. Like if we are talking about the step acquisition, we had an assumption that old investment was sold at fair value and repurchased at fair value. So we credit the carrying amount of the old investment and we debit the fair value in the goodwill, with the balancing figure was used to be taken to the P&L. So this balancing figure of 5 million is a gain on disposal, but this is a non-cash because we haven't actually disposed it off. This is just a gain or loss according to the assumption. So that is why we need to adjust this as well as a non-cash item. Similarly, if I repeat about IES 19, If I repeat about IAS 19, we say that the entry that we record is actually expense debit by the service cost component. We are going to discuss this entry in IAS 19. We record OCI debit by the remeasurement component. And we credit the bank by the contribution amount. This is normally the entry that we make in case of IAS 19. So now this is the amount which is being recorded in the P&L, although it is non-cash. So what we do, we add it back in the adjustments to remove the impact of that expense. And instead we deduct the amount of the bank because this is the actual cash that we have paid. So we add back the service cost component um, in the cash flow statements, and we deduct the amount of the contribution paid instead. Okay, so let's get back to the cash flow statement because this is a lengthy and a very difficult topic. But the gain on disposal will be deducted and loss on disposal will be added. Gain on disposal will be deducted and loss on disposal will be added in the adjustments. In the adjustments, we add the incomes, we add the expenses and we deduct the incomes so that its impact is removed from the P&L. Now, apart from the adjustments, there is one more thing that we record, which is the movement in the working capital. By movement in working capital, we mean the movement, which means the increase or decrease in the inventory. This means the increase or decrease in the receivables, and this means the increase or decrease in the payables. So these are the three things that we record in the movement in the working capital, where increase in assets are a cash outflow and decrease in liabilities are a cash outflow. Because if we are purchasing the assets, that will increase, but we have to pay the cash. And if we are decreasing the assets, which means we are selling the assets and we would be receiving the cash. So increase in asset is an outflow, decrease in asset is an inflow, and vice versa for the liabilities. Apart from this, we also deduct the amount of the interest paid and the amount of the tax paid from the operating activities. So this is how we actually calculate the cash flow from operating activities, by adjusting the profit for non-cash and non-operating activity, by recording the movement in the working capital, and by recording the interest paid and the tax paid. So these are the elements which we record in the cash flow from operating activities. Now, apart from cash flow from operating activities, the next part is the cash flow from investing activities, in which we actually record the movement in the non-current assets and the investment income that we would have received. So in the investing activities, we usually write the purchase of non-current assets, which includes the purchase of property, plant, equipment, which includes the purchase of intangible asset, which includes the purchase of investment property, which includes the purchase of a financial asset, which also includes the purchase of an associate or purchase of a subsidiary. All these purchases are actually a part of the cash flow from investing activities. Sabha is saying, why deduct tax and interest paid? Because Sabha, this is a cash outflow. We would have paid tax, cash outflow. We would have paid interest, cash outflow. And these are the operating activities because we take the loan for the purpose of running the operations. Similarly, we pay tax as an operating activity. So that is why the interest paid and the tax paid are deducted from the cash flow from operating activities. So we have written the purchase of the non-current assets, and after that we are going to write the disposal, which means the sale of non-current assets. And again, the disposal means the disposal of PPE, the disposal of intangible asset, the disposal of investment property, the disposal of financial asset, the disposal of associate, the disposal of subsidiary. The purchases were all cash outflows and the disposal will be all cash inflows. Apart from the purchase and disposal, we also record any sort of investment income that we would have received, such as interest received or the dividend received or the rent income received. All these values received will also be treated as a cash inflow. Plus, if we are receiving any government grant, which is a capital grant, we will also treat that as an inflow in the investing activities. So in total, we record four impacts in the investing activities: the purchase of asset, the disposal of asset, the incomes received, and the government grant received. So these are the four elements which are going to be recorded in the investing activities. Onam is saying, so why do we record government grant? Onam, the answer is pretty simple. Let's suppose you have purchased an asset which had a value of $100 million and the government gave you $10 million for that. This means you have a net outflow of $90 million. So we simply show purchase of property, plant, equipment in the cash flow from investing activities, and we show the government grant received in the investing activities so that it shows the net amount that we have paid. Abdul Qadir is saying, sir, for government grant in relation to revenue, we will record in operating. Yes, Abdul Qadir, you are right. Ali Razak, it does not depend whether the grant is conditional or unconditional. We are reflecting the cash that we have received. So if we are receiving the cash, we need to show irrespective of whether it's conditional or not. So this won't affect the accounting treatment. So this is how we actually get the total value of the cash flow from investing activities. And the next part is the cash flow from financing activities, where we show the issuance or the redemption of share capital, the issuance or redemption of loan notes, where we show the dividends paid by parent, where we show the dividends paid by subsidiary. These are the values which are going to be shown in the cash flow from financing activities. Badr wants to take the snapshot of the operating activity. Badr, here you go. It's a long screen. We can take the snapshot at the end because we are already short of time, only 20 minutes left. The clock is tickling around. So I will share the PDF on the group so you can take it from over there if we don't get time at the end. Okay, now at the end, what do? We get the net cash inflow or the outflow. This is the sum of all of the three activities: operating plus investing plus financing. And then we are going to add the cash and cash equivalent brought down to get the cash and cash equivalent carried down. Cash and cash equivalent brought down will be added to get the cash and cash equivalent carried down. Onam, dividend received from associate will also be in the investing activities because that's a type of an investment income that we are receiving. Yes, Yogesh, you are right. I'm going to discuss that a bit later. Okay, now there's one more very important thing which I have left the space for. If we have a foreign subsidiary, so the exchange gain or loss on cash and cash equivalents of foreign subsidiary is also adjusted over here. If we had a foreign subsidiary, the exchange gain or loss on the cash and cash equivalents of a foreign subsidiary will also be adjusted in between these to get the cash and the cash equivalents carried down. So this is one of the important points which a lot of people don't know, and most of the books don't cover. But we should be aware of this because this has been asked once theoretically in the past papers. So anything which is already asked in the past papers needs to be covered well. And when we say cash and cash equivalents, this means if there's a bank positive, we are going to write it as positive. If the bank is an overdraft OD, we are going to deduct that. And if we have short-term investments, short-term investment means investment which will mature within 3 months, that will also be added. So this is the definition of a cash and cash equivalent where we have bank, where we have bank overdraft, and where we have the short-term investments. Now, when we talk about the dividends paid by subsidiary, we need to incorporate one thing which is very important. That let's suppose we are the parent and we have 80% holding on a subsidiary, and the subsidiary has paid a dividend of, let's say, $10 million. So if the subsidiary is paying a dividend of $10 million, obviously 80% of that will be received by the parent. So parent gets a dividend of 8 million. So from group's perspective, we say that we have only paid a dividend of 2 million because the dividend of 8 million came back into the group. The subsidiary paid 10, parent received 8. So from the group's perspective, we only get we only pay a dividend of $2 million. So when we talk about the dividend paid by subsidiary, so we are only going to record the dividend paid by the subsidiary to NCI, not the entire dividend that is being paid. So this was actually the basics of cash flow. Now we need to study some advanced points relating to the cash flows. Let me add a slide for that. Now, when we talk about some of the advanced cases, let me share an important point that let's suppose if we have acquired any subsidiary during the year, acquisition of a subsidiary, what will happen is let's suppose in 2018, we had one subsidiary parent plus subsidiary one, but in 2019, we have two subsidiaries parent and subsidiary one and subsidiary two, because we have acquired a new subsidiary during the year. Now, if I tell you that our inventory was 40 million in 2018 and it's 60 million in 2019, this is not a like with like comparison because 40 million of the inventory in 2018 is of two companies, parent and the subsidiary one. But the 60 million of the inventory is of three companies, parent, subsidiary one, and subsidiary two. So this is not a like with like comparison. Now the question says that at acquisition of subsidiary, the value of the inventory was, let's suppose, $15 million. The value of the inventory at the date of acquisition was $15 million. So what we do is we need to prepare a T account of the inventory, and we say that the opening inventory was 40, the closing inventory is 60, and we have purchased inventory of 15 along with a subsidiary. So this means that the opening inventory was 55, which has increased to 60. So we are only going to show increase in inventory of 5 in the cash flow from operating activities. We are not going to show entire 20 million. We are only going to show the inventory outflow of 5 million in the cash flow from operating activities. But in the exam, you are not going to have so much of time of making a T account. So what is the shortcut? We actually add 15 million simply in the opening. So this will become 55 increased to 60, which is an increase of 5 million. So it will be -5. So rather than making a T account and then calculating the balancing figure, this will be a quite time consuming activity. So rather than that, we simply add the value of the 15 in the opening. Are you people getting this point? Okay, it's good to see that you people have got the point. Now let's suppose that if I say that in 2018 we had an inventory of 40, in 2019 we have an inventory of 60, and at acquisition subsidiary has an inventory which had a carrying amount of 10 million, fair value of 15 million, and a tax base of 18 million. Now can you tell me what amount should be added in the 40? 10, 15 or 18? Should we add 10 million, 15 million or 18 million in the value of 40 million? Jagmeet is saying 10, Hiba is saying 15, and everyone else is saying 15. Okay. So yes, the answer is 15 because in consolidation, all assets and all liabilities of subsidiary are measured at fair value at the date of acquisition. So if the question is giving us the carrying amount and the fair value both, it is only confusing us. We will always use the fair value at the date of acquisition. But the question is, why is the question giving the tax base to us? Obviously, to calculate the deferred tax. And the deferred tax is the difference between the tax base and the carrying amount. So if the tax base is 18, what value are we going to deduct? 18 minus 10 or 18 minus 15? Shavon is saying 10, Arbaz is saying 10, everyone else is saying 15, Laura is saying 10, and then a lot of 10. Oh my God, so many tens. Actually, the correct answer is 15, not 10. Because from group's perspective, the group has revalued all the assets to the fair value. So for the group, the carrying amount is actually the fair value. Getting the point? From group's perspective, all assets and all liabilities are measured at fair value at the date of acquisition. So for group, 15 is the carrying amount, 15 is the fair value. So always remember, if the fair value is given, carrying amount is just to confuse you. We have to use the fair value to calculate the deferred tax as well as to calculate the movement in the inventory. So this was the first advanced case that was to be discussed. And we have only 8 minutes. So I'm quickly moving on to the next important point. The second important point is that, for example, we are acquiring a subsidiary, and the subsidiary being acquired has a property, plant, equipment of 10 million, and it has some inventory of 5 million, and it has some bank balance of 3 million. These are the assets of the subsidiary, and we are acquiring it for a cash consideration of, let's say, $25 million. This is a subsidiary which we are going to acquire for a cash consideration of $25 million. So now when we write the cash flow from investing activities, we are going to show a purchase of subsidiary by what amount? We are going to show a purchase of subsidiary by a lot of 22s, a lot of 25. Yes, the purchase of subsidiary will be shown by 22 million because we have paid $25 million, and in return we have received the bank balance of the subsidiary as well. So we paid 25, we got a bank of 3. So the net impact of cash outflow is going to be 22. So the value to be shown in the cash flow from investing activities will always be the cash paid minus subsidiaries bank balance. It will always be the cash paid minus subsidiaries bank balance. Yes, Mohammed Faizan, if the fair value is not given, we use the carrying amount. Plus, what if the subsidiary had a bank overdraft? If the subsidiary has a bank overdraft, in that case, we are going to add that value as the cash paid. The bank balance will be reduced and the bank overdraft will be added. So if I say that this was a bank overdraft, this would mean that the cash outflow would become 25 and negative 3, means 28 million. So the bank balance will be deducted and the bank overdraft will be added. This is how we actually incorporate the impact of the purchase of subsidiary. Abdul Razak is saying, don't go, please. Mohammed Mustafa is saying, so basically we are paying off the OD at the acquisition. Exactly, Mohammed Mustafa, you are right. It's sort of a negative cash that we're receiving. Negative cash means is a type of an outflow. Abdul Qadir Saleh is saying, so what if the cash consideration is lesser than subsidiaries bank? Then we yes, exactly, Mohammed Abdul Qadir. Ashita is saying, are we doing any sums on these from the past papers? Yes, Ashita, we have a planned past paper question. The time is short, so I'm going to give you the homework. The question is a homework, and then we are going to solve it at the start of the class tomorrow. So now if I go to the past papers details, um, December 2018 had a cash flow question in the question number 1. So you can open the December 2018 question number 1 by the name of Moyes Group. This is a cash flow question, and you are supposed to try part A and part B at home, these two parts. Part C is IFRS 5, part D is conceptual framework of 2010, which is now outdated. We follow 2018 conceptual framework now. So part A and part B you have to try at home, and then we are going to solve this question quickly in tomorrow's session at the start, and then we will be continuing with the accounting standards. Shavana is saying that we can stay whole night listening to you. Oh my God. Abdul Razak is saying how much you scored in P2. That's a good question, Abdul Razak. I gave the exam of P2 in June 2000 and in fact December 2007. So it is now 12 years since I have passed the P2 exam. Okay. So any questions quickly you can ask. We have 2 minutes and then we are going to continue tomorrow. Abdul Qadir is saying, sir, will you be able to share the PDF and presentation after the webinar? Yes, I will share all of those before leaving the ACC office. Don't worry. Yogesh is saying, sir, you. Okay, thank you, Yogesh. A lot of quick messages. At the last day, can you please discuss exam techniques and tips? Yes, I will share the exam techniques and tips for sure. In the last day, we will try to extend the session by 15 minutes, at least minimum, so that I can share the tips and the exam approach with you people. So once the session is closed, you have to fill the feedback form. You can request ACCA to extend the session for 15-20 minutes at least on the last day. I will also request them so that we have more time to have discussion about the exam approach, about the tips and techniques. George is saying, do we have any income statement question? George, there's no income statement question so far being asked dedicatedly in the SBR exam. So we only have the income statement questions in the exam kits. So you will have to refer it from over there. Jawad is saying, kindly please share the latest current issues and the framework. Yes, I will be sharing the current issues and the framework on day 5. Siddharth is saying conceptual framework 2018 includes changes regarding new definition derecognition. Yes, exactly, Siddharth. That is so. Onam is saying, sir, please share some cash flow special cases in WhatsApp group. Okay, Onam, I will share a WhatsApp, a short presentation about the cases of the cash flow statements. But again, I won't be able to get time till the completion of the webinar. I will try to get to stay connected with you people on the WhatsApp group after the classes are end. Siddharth is saying, sir, foreign operations class. Siddharth, foreign operation treatment is similar to the foreign subsidiary. So there's no difference in that. But the foreign transactions are different than the foreign subsidiary. We don't plan to discuss that area in the webinar because that is being asked for approximately 25 marks in the last June 2019 attempt. So the time's up. Thank you, everyone. It was a quite good session, always like with you people. So looking forward to meet you all tomorrow. Till then, take care and Allah Hafiz.